Hi, I'm Jimmy. In this video, we're looking at something called the flow of funds. And basically, this is how much money is going into or out of stock ETFs or bond ETFs or even commodity ETFs. And by watching where investors are actually putting their money, maybe we can find some unique investing ideas or investing insight. Okay, let's jump right in. So I broke out our data into three main groups: equity, which is the same thing as stocks; fixed income, which is the same thing as bonds; and finally, commodities. And these are things like gold or silver, iron ore, things along those lines. Okay, now like I mentioned before, this data is money going in and out of ETFs. So when I say bonds or commodities, I'm talking about bond ETFs or commodity ETFs. It doesn't include what people are directly investing into bonds or if they're actually buying a futures contract for oil or something like that. But either way, I still think it's good information to have nonetheless. Okay, now just so we're all on the same page, this data the data for equity ETFs actually came from more than 6,000 different ETFs. I'll put the exact number below the name of each group. But either way, for stock ETFs, we can see that this includes a ton of different ETFs. Plus, these equity ETFs, these stock ETFs ultimately represent about $7.3 trillion. So we're talking about a ton of money here. Then for the bond group, well, here, this group has more than 2,000 ETFs in it. So again, a decent amount. Plus, that group represents about $1.7 trillion. Now, of course, generally, the bond market is much, much larger than the stock market. The bond market, I think, has like 110 or 120 trillion dollars in it worldwide. And I think there's almost 50 trillion in the US bond market alone. So this is only a small piece of the money that's in bonds, but again, it should serve our purpose as to where money is flowing. Okay, then we go over to commodities. Now, commodities, we have just 943 ETFs, and they got about $283 billion in those ETFs. So this is our smallest group. Okay, now over the past 3 months, we've seen $179 billion go into stock ETFs. That's an increase of about 2.5% from where it was 3 months ago. Now, when I say $179 billion went into it in the past 3 months, I'm talking net. So some money came out, some money went in. If you offset them, how much money came in, subtract how much money went out, there was $179 billion remaining. If more money flowed out, this number will be negative, just so we're all on the same page. Then for bonds over the past 3 months, well, bond ETFs have picked up an additional $75 billion. That's an increase of 4.6% from 3 months ago. And the fact that bonds have seen a bigger jump from a percentage standpoint does make some sense, I suppose. After all, if we think the stock market is a bit too overvalued, bonds historically are a safer move. Plus, the fact that we're seeing almost 5% money, a 5% increase in the money going into bond ETFs when bonds are paying almost nothing. Bonds are, they pay interest, and interest rates are so low right now. I think that this only amplifies the importance of this flight to safety. People apparently are willing to get almost no returns for their money to stay in safer investments. Now, in a minute, we're going to look a bit closer at which bonds are actually taking money, and I think there's more insight there because we could break these groups down a bit further. But for now, commodities picked up about $4 billion over the past quarter, and this is an increase of about 1.5% for commodities. So at first glance, nothing too big. Okay, how about year to date? So we can see that equities took in about 8% more money than they had at the start of the year. Once again, bonds actually took in a bigger percentage compared to what stocks took in. And I think this really confirms our belief that there is a certain level of a flight to safety happening right now. People are actually putting their money in bonds, which again, in my mind, is a little crazy. Then, also interestingly, commodities actually lost money since the start of the year. Since the start of 2021, they've given back about $1 billion. That means people took out $1 billion more than everybody else put in. Now, I'm a bit hesitant to draw too many conclusions at this point for commodities, but we'll come back to this one in a second. Okay, how about over the past year? So we just did year to date, which is from the start of 2021. Now we're going back to August of last year. Well, now we can see, once again, there's a bigger jump in the money going into bonds than there is going into stocks. Plus, the money that is heading into commodities is once again negative over the past year. So it seems that money seems to be leaving commodities again. And then in the past 3 months, money has flowed in. And clearly, there has been a push in the past 3 months to go towards commodities, which is logical considering the inflation fears that are out there right now. Historically speaking, commodities do fairly well in a higher inflationary environment, so it makes sense in my mind that over the past 3 months, money's heading in there. And I actually think that this is one of the interesting parts to this type of data. You might pick up on something or some trend or some idea, some investment idea that I'm not seeing because frankly, there's so much data here and there's so many possible ways to look at this. So with that being said, let's go back a little bit longer and look at 3 years and see how things have shaken out from pre-COVID to today. Okay, here we can see that pretty much every category saw a decent jump in the assets that they took from over the past 3 years, from 3 years ago to today, which is logical considering that the stock market's up near all-time highs and pretty much everything has been going up for the past few years. So this is somewhat logical. Okay, now let's dive in and look a little bit closer at the types of stock ETFs and which groups took the most money. So we have broad market ETFs, then we have large cap ETFs, mid cap ETFs, and small cap ETF. Now, clearly there's a lot of data here, and I'll tell you what my biggest takeaways are from this data, but please let me know in the comments below what you think is most interesting here, because I actually think that as a community, we could put together some really interesting ideas if you were to pause this, look at the data and say, okay, well, what about this? Is there an opportunity here, an opportunity there? So whatever you come up with, please let me know in the comments below. So my first thought is that it's interesting that broad market ETFs seem to have taken in the most money from a percentage perspective, except over the past 3 months. Over the past 3 months, large cap stocks took in the most money. And again, considering what the S&P 500 is doing and where it's currently valued, I think that this is logical. Now, I also think it's interesting that across the board, when we look at all this data, mid-cap stocks have taken the least amount of money in, both in actual dollars and from a percentage standpoint. So frankly, I think that this could be a real opportunity. From an investment perspective, I think that avoiding what the crowd is doing makes a lot of sense. And since we can see that the crowd is going into either broad-based ETFs or the large cap stocks, I think looking at mid-cap stocks or secondarily small cap stocks, because they too have a minimal amount of money going into them, I think going after those stocks could make a lot of sense. I think it's possible we find some real gems over in that space. So when we look at the flow of funds for bond ETFs, well, one of my biggest takeaways is that it's exactly what we might expect. This year, and even more so in the past few months, inflation-protected securities are really taking a lot of money relative to their size. So clearly this confirms our thoughts around investors are worried about inflation. Now, I know that that is already obvious, but the problem with a lot of money going into inflation-protected securities is that drives the price up of inflation-protected securities. When the price goes up, the yield, the amount of interest that we receive, not the amount of interest, but the percentage of interest we receive actually goes down. Yield goes down if the price goes up. So if we were to jump in today and buy that very same product, our returns are going to be far weaker than they would have been 6 months ago. So I think we might, I understand the desire to do it, but I'd rather avoid the crowd. Oh, and by the way, if we're wondering what aggregate bonds are, well, this is a lot like the broad-based stocks segment that we had. Broad-based, do they invest in everything? Aggregate bonds is very similar to that. They invest in all different types of bonds, so it's really just a broad basket of bonds. Now, I gotta say, while I was doing this research, I was actually surprised to see how much money was flowing into bonds despite how ridiculously low interest rates are right now. So I think it's very interesting, and clearly some investors are perceiving bonds to be safer and are heading into those investments. Personally, I'm still a big fan of stocks, and I think that there could really be some great gems out there in the mid-cap space or the small-cap space. If you know any, please let me know in the comments below. Now, of course, we don't want to overpay for these stocks. That's why I think that mid-cap stocks could be interesting. A lot of times they're big enough that the risk of them going out of business might be less likely, but they still have enough upside potential that we could really make a great profit from them. Now, if we want to see an interesting way of looking at the fair value of a stock or even the stock market, well, I recently did a video called how overvalued is the stock market today, and I tried a little something different in that analysis. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really, really do appreciate it. Thanks, and I'll see you in the next video.